Welcome to the Canadian SME Small Business Podcast. I'm your host, Maheen, and today's episode is all about unlocking the strategic advantages of financing for small businesses. We'll explore why financing new equipment has become easier and more flexible than ever, and how businesses can use it to boost their growth without draining cash reserves. As small businesses across Canada strive to innovate and expand, smart financial decisions are crucial, and we believe that today's discussion will really resonate with business owners seeking practical and sustainable ways to grow. Our guest today is Michael Fox, the Vice President of Sales at Mitsubishi HC Capital Canada. With over 30 years of experience in managing transportation, construction, manufacturing, and aviation portfolios across Ontario and Western Canada, Michael brings a wealth of knowledge on financial solutions. His expertise in helping businesses achieve revenue growth, customer satisfaction, and embracing innovation makes him a dynamic leader in his field. So please join us as we dive into this insightful conversation and explore how financing can be a game changer for your business. Michael, we're so honored to have you on the podcast today. How are you today?
Well, I'm doing great, Mee. Thank you very much. And I really appreciate the opportunity to talk to you and all your viewers. So looking forward to the conversation.
Thank you so much for joining us. And we're very excited to dive into your wealth of experience and insights. And it's really a true pleasure to have you on the show. Now, Michael, small businesses often view financing as complicated and inflexible, especially when it comes to acquiring new equipment. However, the process seems to be evolved today, and financing, equipment has become much more accessible and tailored to meet business needs. Could you please tell us why financing new equipment has become simpler and how businesses can take advantage of this flexibility?
Sure. I'd say there's probably two main reasons why it has become more accessible and a little bit more flexible. Basically, first off, there's more funders out there willing to finance equipment. I think if you went back a number of years, it was a smaller group, a more specific group, and there weren't the financial products available via those funders or lenders or providers of capital. So I think right now we're seeing a time in the marketplace where the lenders are much more sophisticated and they're much more committed to providing that type of product. I'd say another main purpose of this is that there are more manufacturers of equipment that are using financing to help sell their products. One only has to look at the auto industry, which has been doing it probably well over 20, maybe 30 years of selling financing as part of their sales process and allowing customers to be able to look at a more affordable, perhaps, or better cash flow to acquire that equipment. We're seeing that in other manufacturing verticals now more and more, where the manufacturer and the dealerships are providing financing options right at the time of sale.
Well, that's really enlightening, especially for small businesses or small business owners, I should say, who may have been hesitant about exploring financing options. Michael, can you please share an example where this flexibility has directly helped a small business grow or manage their cash flow more effectively?
Sure. We've had numerous examples of that, but I think one, in preparing for this, I was looking at it. I think one that's kind of been around for a little bit, and it's growing even more. Customers may have specific contracts to use that require new equipment that they have to use to fulfill that contract. And it might be a 2 or 3 year contract. At the end of that contract, they're not sure if those assets fit into the rest of their day-to-day business model. So making an investment of capital up front, carrying that capital all the way through the project, then having to sell that equipment, most likely at the end, recoup whatever is possible at that point in time, is a little bit more cumbersome than perhaps just funding it or leasing it or financing it for that period length of the contract. So in other words, you have a 3-year contract, you have a 3-year lease term. It gives you that option. Okay, at the end of the term, I can still keep the equipment if I want, but it kind of matches up to their cash flow exactly when they're factoring out and bidding on contracts.
Well, now that we've covered that, let's move on to why using financing may be a smarter move than just paying cash outright. But before I do, I really want to connect with our listeners. Listeners, did you know that financing isn't just a safety net? It can really help you grow faster by allowing you to acquire the needed resources without draining your cash flow. So think of it as an intelligent investment in your business's future, and really stay tuned to hear how this strategy can work for you. Now, Michael, many small business owners may think that paying upfront in cash is the safest route. However, financing offers some, distinct advantages that cash doesn't always provide. Why would financing equipment or other needs be more advantageous than paying in cash for a small business?
Well, I mean, I think one of the main things is being able to retain that capital in your business for other ventures, and that could be expanding your business. It could be for personnel. It could be for any type of business expansion that you're looking at, or even just day-to-day managing of your business. So I think that when a company, especially a smaller company, that maybe cash is not as much on hand, capital is not as readily available to do some of these other things that you might not be able to finance. Being able to save that capital in the business and use other people's capital basically to bring that equipment in can make real financial sense.
Mhm.
A second part is depending on the type of industry that they're in, purchasing equipment and using cash, you're buying a depreciating asset most of the time. And with today's technology, many of the assets that they're buying, they become outdated in 3 or 4, maybe even a shorter period, depending on what it is, year time frame. Being able to finance it and have flexibility to return the equipment, bring it back, sell it off, bring in new equipment, work with the manufacturer, the dealer, to be able to do that gives you a flexibility to stay on top of the most modern equipment and to keep your business model, whatever that might be, running more efficiently. So I think those are two big areas that especially smaller businesses can definitely take advantage of.
And that's a crucial point, really, about maintaining cash flow and giving businesses more flexibility. But, Michael, are there certain industries where you've seen the strategy work particularly well?
Yeah, I mean, the standard ones are transportation and construction. I mean, if you look at a transportation company, large or small, you're talking about each truck is 200 to $300,000. So 10 truck fleet all of a sudden is pushing $3 million in capital. Very, very hard for a small company to be able to afford that. So financing those assets makes sense. Same as the construction side of the business. And I think what a lot of companies need to look at, and in certain industries, is are these assets revenue generators or are they not? And if they're generating revenue, can I match that revenue to the capital that I'm putting out? And that can kind of carry across most industries. It's a very standard principle that they can look at.
Hmm. No, it's amazing how preserving cash flow can really lead to greater flexibility and security for a business. And to our
Yeah.
listeners, financing isn't just a fallback plan; it's a very strategic move. And by using financing wisely, you can hold on to your cash for other opportunities, ensuring that your business has the agility to adapt, to grow. So please remember, it's not about spending less; it's really about growing smarter. Up next, let's explore how small businesses can use financing as a strategic advantage. Michael, you work with businesses of all sizes, and I'm sure you've seen how financing can go beyond just acquiring equipment. It can be a very powerful tool for strategic growth. How can small businesses use financing not just to acquire equipment, but as a strategic advantage in their operations?
Well, Maheen, one of the ways you can definitely look at it is how do you use this to grow business? How do you use it to bring in more business? And I think, some of the areas are with the creativity that's out there today. Financing, you're only paying for the time you're using the assets. So a short, very period of time. And you can use that as you're bidding on business. We mentioned earlier about contracts and being able to price out what you're giving out to your customers, and how do I reduce those costs, and how do I make that more efficient for us to be able to provide better products. Another product that's getting much bigger in the financing industry is equipment as a service. So perhaps that you're taking a piece of equipment that you're not using every day, all day, but you're using it in peak periods. And there's ability now to be able to just match your lease payments to those revenue streams. So again, you can be more competitive in your marketplace to be able to charge your customers more in line with what your costs are, which really it gives you a strategic leg up on your competition, hopefully, as opposed to the traditional ways of being able to price out your business.
Mhm. Well, that's a very powerful perspective. I mean, using financing to actually fuel long-term growth rather than just covering, immediate needs. But can you please share any success stories where small businesses have transformed their growth trajectory by leveraging financing in this way?
Yeah, so we have a number of those. I mean, obviously, we like to think all of them do, but some specific examples are, if you look in the manufacturing sector, where companies have been able to do that is, to upgrade their equipment, and what it's been able to do, not only become more efficient from the actual equipment, but it's actually also been able to help them perhaps reduce the manpower costs. So a job that used to maybe take 5 to 10 employees over 2 shifts to do may now only take 1 or 2, because you've been able to upgrade your equipment into this new, more modern, more technologically advanced piece of equipment, and therefore you're more efficient. Maybe you can run 24/7 now. We see that more in the manufacturing side, whereas before you couldn't, because you didn't have the manpower to be able to do it. So now you might be able to bid on jobs and deliver your products in a quicker process than you were before, because you've been able to use financing to bring in this more modern equipment, which again could give you a leg up on your competition.
So it's so fantastic to hear how financing can be used not just for immediate needs, but as part of a larger plan for sustained success.
Yeah.
Coming up, let's dive into the different financing options that are available to small businesses and how can they choose the best fit. Michael, the world of financing offers many options and it can be a bit overwhelming for small business owners to figure out which path to take. What are some of the most common types of financing that small businesses use, and how can they determine which option is the right for them?
Sure. Well, there's a number of them out there. One of the most popular ones, and it's using a line of credit with a bank. Okay, and that's or with another funder, and a line of credit works much like any of us would have a line of credit. You have a say $100,000 facility, and you're able to take money out of it to buy equipment, and you pay it back as you go through. But on the actual specific equipment financing side, capital leases are the most popular. They're very much like a loan. So you take out a loan for a piece of equipment over, say, 5 years. You usually put a small down payment on it. And at the end of that term, you assume ownership of that equipment. Pretty straightforward, much like most other financing avenues that customers take. But there's also fair market value leases, and these give customers an ability to lower their monthly payment and be able to use the equipment for a very short, specific period of time. And at the end of that period, they have the ability to give the equipment back or to renew their lease or to buy it out at that point in time. And the nice part about those types of products is it really gives a lot of flexibility to the customer. So you're not committed to it over an extended period of time. You might be committed for 2 to 3 years. Then you have the opportunity, depending on which way your business is going, to make a different decision when that happens. And I mentioned earlier, one of the newest products that we have available is equipment as a service. And this is really exciting in our business. So companies may have peak periods through monthly, quarterly, whatever timeframes they might have, but they can structure their payments to match when they use. So basically, if your high usage is, say, in middle of the week or certain months of the year, you would structure your payments to match that revenue stream. And it gives you, again, much more competitive balance to be able to match those payments with your revenue, as opposed to having a flat payment stream and revenues that fluctuate, and put perhaps a customer in a little bit tougher period in lower revenue times where the equipment might be sitting idle more than it's being used. So again, there are a number of great products out there that are available for large and small customers.
Michael, that's really helpful. Really breaking down the different financing types so business owners can really understand what works best for their particular situation. But do you have any tips for small business owners on how to really approach lenders or financing companies to get the best deals?
Sure. Well, I think it's really crucial to make sure that you understand your business plan. You may not be an expert on the equipment financing, but be able to explain what your objectives and goals are. Therefore, let the equipment finance experts then tailor something that parallels to what you're looking to do. What's most important to your business? What are you trying to achieve? Is it cash flow? Is it equity in the assets? Those types of things are very key. And then the equipment lending company can work with you to tailor that to make sure that it matches what you're looking for. You want to find a lender or a provider that has more of a consultative approach, and that's really important as well. We want to bring that our experience and our knowledge to your business. We deal probably with customers in your industry or very similar type industries. So, we have a wealth of knowledge where we can bring that and help structure packages for you. So it doesn't have to be as daunting as it might look. We are here to help. And I think that that's a key part to find the right partner that you're looking for.
No, it's great to know that there's so many tailored options available depending on a business's specific goals and needs. And Michael, you've shared a lot of valuable information with us today. But, as we're about to wrap up, I'd like to get your final thoughts on this topic. What is that one key piece of advice you would like to give to small business owners who are thinking about using financing for the first time?
I think the main thing I would say is do not be afraid of debt. And at the end of the day, this is debt that you're bringing on, but debt is manageable, and debt, it can be a very large benefit to your small business. So understanding it, managing it properly, working with a good partner, these are all key components. And sometimes small businesses are leery of adding debt to their business, but I think if it's managed properly, companies all around the world, small to the largest multinationals, all use debt to help grow and enhance their business model. And I think for small businesses, that opportunity is there for them as well.
That's excellent advice, especially about building relationships with financing partners. But to build onto this a bit more, Michael, are there any common mistakes that you've seen small businesses make when it comes to financing, and how can they really avoid them?
First one I'd say is probably know your partner. Our industry is a very strong industry, but I think that you need to understand that there's full disclosure on what you're actually getting yourself involved with. So make sure you understand what your interest rates are, what your terms are, understand the T's and C's. There's an old saying, too good to be true. Sometimes it might be, right? So I think that that's a very important part. Make sure you also talk to probably a couple of providers as well when you're making that initial decision, so you can get a different point of view and understand what options are out there for you. Because sometimes if you make the wrong decision in your partner, the process may not turn out that well. And we don't want that to sully your view of the whole industry. It's very important to understand who you're dealing with and making sure that what you're getting is what you're expecting and what's been explained to you.
Well, thank you for that, Michael. Your advice has been insightful, and I'm sure many of our listeners will feel more confident about exploring their financing options after today's discussion. Now, as we have come to an end of today's discussion, what key takeaways do you hope small business owners will remember about using financing as a growth tool?
Well, a few things I'd say, Neen. One is, be strategic. Really, this is a strategic play for your business. Okay, you're looking at use it as a growth component, use it as an expansion component, use it as a mechanism to help you move your business to that next level or maintain the level that you're looking for. But be strategic when you're looking at it, not tactical. Understand both sides, the impact on your financial statements and the impact on your business operating system when you're looking at, borrowing this money as opposed to using cash for it. What's the impact going to be? How is it going to affect me? Make sure you look at it, do proper forecasting, use your partners to the best of your ability to be able to help you with that and to be able to give you some comparatives on what other companies are doing and what results they're looking at. We have that information, and we can, outside of naming names, we can share what trends are and what companies can see. So these are key things. Use your lender as your partner, not as a vendor, and we can definitely help with the advice and the consulting to make that right decision.
Well, thank you so much, Michael, for sharing your expertise and insights with us today. It's been a pleasure to have you on the podcast, and I know our listeners will benefit from everything that you've discussed. So thank you for your time.
Well, thank you. Very, very much appreciated, Maheen.
And that brings us to the end of this episode. Thank you so much for tuning in today. I hope Michael's insights on leveraging financing for small businesses have been helpful. From accessible financing options to preserving cash flow, we've touched on the key growth strategies. If you're a business owner, consider how financing can fuel your growth. And thanks for tuning in again, and join us next time for more tips to help your business succeed. We'd also like to take a moment to thank our sponsors, RBC, UPS, Constant Contact, IHG Hotels, and Google for their their invaluable support in making this podcast possible. To our listeners, don't forget to visit our website, CanadianSME.ca, to subscribe to the Canadian SME Small Business Magazine. Stay tuned for more insightful content designed to help your business thrive in today's competitive landscape. See you in the next episode.